Welcome to the Market Huddle with Patrick the Content Machine Ceresna and Kevin the Macro Tourist Muir. So grab a drink, get comfortable, and get ready for a deep dive into the markets. Take it away, guys.
It's January 10th, 2020, episode 62. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we welcome Benn Eifert from QVR Advisors. We have a great talk about a wide array of macroeconomic issues, including the recent repo crisis, the increasing preponderance of institutional option overwriting, and the problems arising from the growing popularity of quant investing. Then we bring back Tony Greer for an update on the markets. Then we get Patrick's new segment, the Talking Charts with Patrick. And for our WTF video, Kramer does his best Joe Pesci impersonation.
And in This Week in Trading History, we're going to talk some Fibonacci's as well as discuss the top 3 things to watch next week. So let's get started. But before we do, Lena, hop on here. We have to talk about our beer sponsor. Who's sponsoring the show this week?
So this week's sponsor is Harold House Brewing Company's Perth County Conspiracy North American Pale Ale.
Okay.
I like the picture of it.
Yeah, so what are we about to get here?
A hop-forward pale ale with reserved but perceivable bitterness. A North American pale ale is driven by a deep golden hue and pleasant tropical notes. It attains well-rounded bitterness, a soft stone fruit, and assertive mango character.
I actually really like it.
There's also an additional note here.
Go ahead, Lena.
Perth County Conspiracy was a cult classic rock band based in our very own county in the 1970s.
It looks like it. That's what the guys look like.
Yeah.
Patrick, it's very unusual. We both like it. I think it's a plus.
That means everyone should sell.
That's right. Okay, let me
All right, give a disclaimer, buddy.
Yeah, nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include energy market vampirism, BTFD irritation, and liquidity injection schizophrenia.
There you go. All right, let's get on with the show.
Joining us now is Benn Eifert from QVR Advisors. Ben, it's a pleasure to have you with us today.
Yeah, it's great to be on the show. Thanks.
I must admit, I came upon your Twitter account, and I've been fascinated by it because you have been able to explain a vast array of different complicated topics in very easy-to-understand terms. And I thought to myself, this would be a great guy to have on the Huddle. So I reached out, and I'm just pleased as punch that you're appearing today. But before we get into those things, why don't you tell me a little bit about yourself? What did you study in school, and how did you come about getting into this business?
Sure. So, I am a emerging markets macroeconomist from the old days. I think I was an undergraduate in economics. I worked for the World Bank for the chief economist of the bank as a macroeconomics researcher. Spent a lot of time in India and Africa and Latin America. Was based out of DC. Went back to graduate school and did a PhD in economics. Moved away from more of the emerging markets macro and more into finance. In that process, taught in the Master's in Financial Engineering program at Berkeley for a while, and worked for a hedge fund for a while I was in graduate school, and then my first real job out of graduate school was on the Wells Fargo prop desk, which not that many people even remember existed. We were, probably the 47th best prop desk on Wall Street. But importantly, we were at a bank that weathered 2008 extraordinarily well, because Wells Fargo was really a very simple bank that had almost no exposure to the really problematic structured credit derivatives that blew up a lot of banks in 2008. So as a prop desk, while every other prop desk that was smarter than us were getting fired, we, had a lot of support from the bank and were able to, really take advantage of market conditions in those times. So that was super. That prop desk eventually spun out and became a hedge fund called Overland Advisors. And so we dealt with that after the credit crisis. Eventually, I started another fund called Mariner Coria, doing relative value derivatives investing with a partner out in New York. But then more recently, I started my own firm in San Francisco called QVR Advisors. So that's where we're at.
Well, that's a fascinating background. So you are truly one of the a finance quant nerd, I would say. You know, when you tell me your degree, don't you think with basically a degree in financial and a PhD in financial engineering, is that correct?
PhD is in economics, but yeah.
Oh, okay. It was in economics. And so what have you noticed? Like, you know, you've been in the industry and you've also been in academia for a long time. With you know, that PhD, what do you find is the difference between the corporate side versus academia? Like, how much do you find that you enjoy the old days of learning stuff at universities versus the competition on Wall Street?
Oh, it's hard to say because it was a very long time ago that I was in academia last. But I mean, they're very different, right? I mean, academics certainly at the level of like a top program in economics or finance. I mean, you're speaking to an extremely narrow audience, right? You're writing research that's read and avidly discussed by a few dozen people around the world, and you're really extremely specialized and general, often sort of highly theoretical, or anyway, maybe with an empirical bias, but that's again pretty narrow. So it's just a very different thing, right? And with a very long, work cycle and output cycle, versus obviously in trading and investing where, day-to-day returns and performance are important.
And so what have you noticed over the past couple of decades that you've been involved in the markets has changed the most? You've had quite a varied career, and you've been seen a lot of different parts of the market. How has it changed from kind of 10 or 15 years ago?
Many different ways. I'll pick a few, I suppose, that stand out the most. So first, we are primarily derivatives and options traders and investors. Derivatives markets in general have gotten much more efficient over the last 20 years, for sure, as have many markets, not only derivatives, but certainly 20 years ago, you would see derivatives markets were much more opaque, much smaller, much more niche-y. You would see much larger inefficiencies from time to time in those markets. Whereas, these days the world is full of many sophisticated organizations with lots of capital and very big teams and strong technology. And for the most part, there's the gross inefficiencies I think of the old days are mostly arbitraged away, and those markets function, generally speaking, in a pretty competitive manner. So that's certainly one big change that's happened. Another big change that has happened is and really in a related sense, there's much greater and wider participation of who you might think of as end users of derivatives, of pension funds, of asset managers in derivatives markets and options markets, right? So 20 years ago, your average mutual fund or pension fund really didn't use options or futures much at all. They were considered, esoteric and exotic instruments. Whereas these days they're very heavily used for income generation. Think of call overwriting and put underwriting strategies. Think of basic hedging type of approaches. Generally speaking, there's very broad participation and usage of options and futures across very typical market participants these days. So that's certainly very new, or is a new thing over the last 20 years. And I suppose another thing worth mentioning, just much more technology intensive markets and much more technology intensive execution in marketplaces versus 20 years ago these days.
So are all those developments, the liquidity, the more users, and the technology all good things, or is there a hidden dark side that we're not realizing?
I think that for the most part, those are all good things. I think that certainly the increasing or decreasing less inefficiency, more efficiency in the market is a good thing for the market and for the world. It's not necessarily, it makes it a little bit harder to make a bunch of money as a hedge fund style strategy. But I think that that's not the end goal that the world is looking for. So that's okay. On the technology side, there are, I think, generally speaking, technology has greatly improved efficiency in the marketplace and improved and reduced costs for market participants to execute, there certainly are trade-offs in some areas about, liquidity with, high-frequency trading and so forth. But I think generally speaking, the much increased role of technology in finance, I think, is primarily a good thing.
So what do you say when you see the zero hedge type headlines that talks about all the trillions of dollars of derivatives out there and how this is all going to end in a fiery mess? What would be your pushback to that kind of worrisome saber kind of rattling?
Yeah, I think sort of deleting zero hedge straight off of your feed is kind of the right place to start to sort of make sure you're thinking about the world in the right place. And there's many levels on which that's true. Look, those guys, make money on clicks the same way that the whole sort of, clickbait advertising world does. Specifically with respect to, derivatives, notional, those kind of numbers are totally meaningless, right? So there can be big problems in derivatives markets. The credit crisis was a great example of that. There will be problems in the future in derivatives markets, but whether there are $1 trillion or $5 trillion or $20 trillion of derivatives notional on Deutsche Bank's balance sheet is not going to tell you anything about that, right? The sort of dollar notional of derivatives is a very misleading concept. It's informative only when you're looking at one very specific type of derivative and comparing the size of the position or something like that, right? You're comparing interest rate swaps or interest rate swap spreads that have, that might have hundreds of billions of dollars of notional, but a maximum amount of gain or loss of financial value of a few $1 million, with variance swaps, for example, in the equity derivative space, which might have only a few $1 million of notional value, but enable losing many times that in a bad event. So it's just all, those types of numbers and things that people throw around in the zero hedge camp just don't tell you anything. You got to know what exactly you're talking about. What are the exposures? How do they work? How do they net? What's the risk associated with them, and so forth?
Right. So, you mentioned swaps in there, and I kind of reminds me of one of your tweets that you sent out. It says, suffering through equity traders talking about the repo markets this last few months has renewed my appreciation for the iconic equities in Dallas put down. So I think that was a great tweet. I loved it. It was Liar's Poker, that famous line, equities in Dallas, there was nothing worse. Why don't we talk a little bit about the repos, gate or apocalypse that everyone was going through? And you have a repo story about Uncle Vinny's shop. And maybe you could just kind of recount that to us, because I think it did a great job of explaining what went wrong and how an average person can go and understand the problems associated with the repo market.
Sure. So I would encourage listeners to do a search for that tweet thread to get the full thing, because I probably won't be able to to do it proper justice in all of the different spots. But I think the key thing to understand here, right? The thing that's really different about the world today versus the world pre 5 or 10 years ago is that regulators have introduced what's called Basel III, and phased in all of the regulations and requirements for banks associated with Basel III. And so there's many different pieces of that, but some of the most important are effectively that banks have to not only meet minimum reserve requirements, as they always have, so in terms of the amount of loans and liabilities they have outstanding, how many reserves at the Fed do they have to hold. But it used to be in the old days that effectively, intradaily, there's all kinds of payments back and forth. There's money going out and money coming in, and they only had to really satisfy those reserve requirements at the end of the day after being able to lend and borrow in repo markets to make sure everything is trued up. Today, post Basel III, there's what's called liquidity coverage ratios and intraday liquidity requirements that are akin to saying, not only just at the end of the day as a bank do you have to meet those requirements, but you have to have very large buffers at any point during the day, regardless of, even if you have just had to pay out a whole bunch of money. And also, by the way, you have to pre-fund, calculated outflows for the next month. And so if you don't, and if you're sort of caught in that type of situation, you can get a big fine and a big wrist slap. So the analogy to Uncle Vinny's shop, that I was just trying to paint to help people, get their head around this a little bit, was just that of a typical shopkeeper, right? When you think about, a shopkeeper, there's always money coming in the door and going out the door. And sometimes there's more money going out because there's, new goods that are coming in. The delivery guy's bringing in the fish, and, Vinny's got to buy the fish, and, some cash goes out the door, and he's got to meet payroll and all that stuff. And at the same time, there's money coming in from customers, and, there's lumpiness in the flow of money coming in and the flow of money coming out. In some sense, in the old days, Uncle Vinny, in the Fed analogy, used to be able to, just sort of write all that stuff down in a book, make sure that the money going in and the money coming out, averaged out pretty well over the course of the month, and settle up all of his debts. Everything was kind of an IOU that could be settled at the end of the month, and that was no problem. But then, the local politicians decide, there were a couple of shop owners who, were doing some dicey things and got in trouble. And so the local authorities had to bail them out, and the local authorities decided, that now they're going to be sending in book checkers every day to, places like Uncle Vinny's shop to look at their books and make sure that literally they have, a bunch of cash lying around to meet all the possible obligations they might have for the next month in the shop. Right, that causes a big cash shortage, because that doesn't just happen to Uncle Vinny, it happens to everybody else that's like Uncle Vinny, right? And so now if Uncle Vinny's cousin, needs a loan for his shop because, he's running really tight because, it's Christmas time and he's having to buy a whole bunch of goods to get his shelf all stocked, Uncle Vinny's, business might be in really good shape, but he's probably not going to have the cash to lend to him either, right? And the key thing to understand, again, among banks here is, people talk about the Fed balance sheet a lot. Many of them just don't know what it is or why it even exists or have any concept of this. The quick answer is, in a post-Basel III environment, the Fed balance sheet is just going to be a ton bigger than it used to be in the old days. It has to be that big, or else there's literally just not going to, under any kind of stressed funding conditions where, there's been a bunch of treasury issuance and where banks have been or where corporations have been meeting their tax payment obligations because it's that time of the year, there will just be a big shortage of reserves in the banking system to just clear payments, right? And that's a result of how much, in some sense, less efficient the reserve pool has become, because we're forcing banks to hold on to all this cash kind of intradaily and have these very big requirements. And does that mean it's a bad thing that those regulations are in place? Not necessarily. What they're designed to achieve is that, financial stability goals, basically making sure that there's very little chance that banks could get in trouble with the amount of, liquid cash they have on hand and so forth. But if you're going to do that, then the reserve balances in the system have to be large enough to kind of provide that lubrication, right? And that's, kind of what we've discovered is the Fed did a whole bunch of quantitative tightening and reduced its balance sheet a bunch. And then what it turned out, it reduced its balance sheet too much in the banking system, briefly. And the payment system, once it came under stress, briefly froze up, and we had to come back and inject some more money in it.
So let's put your economics hat on. Do you think that increase in the balance sheet is inflationary for the general economy?
No, it's not, because the whole point is, right, those reserves are just sitting in. There have to be very large balances of excess reserves sitting at banks, or banks have to hold them at the Fed, just in order to ensure that they're meeting regulatory requirements, right? So the balance sheet, right, money is inflationary when somebody has it and can spend it. Right. That's kind of the whole point, right? Quantitative easing did not turn out to be inflationary in practice, because that was not money that, got into the banking system, got loaned out and went to people who then bought cars or built businesses with it. It just built up in massive supply as a liquidity pool in bank reserves at the Fed, right? And what's happening now is the central bank balance sheet has to be much bigger just to support the basic payments system in the banking system actually clearing on a day-to-day basis under stress conditions. But that's all money that's just sitting in required mandated reserves and cushions to enable banks to meet intraday liquidity coverage requirements under stress.
Right. So
it's
now we're
kind of right.
So now we're getting into some ideas that are kind of I would say the traditional economists might push back a lot. A lot of people just kind of look at the Fed's balance sheet and go, look, this is going to cause inflation. I happen to be in your camp that this isn't inflationary and that's not going to cause general inflation like everyone is worried about. But I was wondering where you stand in terms of the MMT argument, because many of these things are kind of touched upon in MMT. And I was thinking I would just love to hear your thoughts about the whole kind of movement in general.
Yeah, I think, you can interpret, I think, MMT in a lot of different ways. I think if you take the one core idea of MMT as, the government is not at the end of the day limited in its ability to spend money by, having dollars, it's limited by the level of inflation. And that's sort of just mechanically true, right? That's not actually something you can argue with very effectively, because of course the government can create more money. That's sort of what central banks can do. And then the question is whether in doing so, where does that money go? What is it used for? And does it create inflation, right? So I think that part is certainly true. I think the next, if you take MMT, then kind of a few steps further about what, the sort of actionable implications of that, that's where I don't really have a strong, particularly strong opinion or agreement with, some of the proponents of that type of school. Like, therefore, the government can and should spend a whole bunch of money and it won't be inflationary or something like that. I think that's, there are nuanced questions around that. I think that it's certainly true that, we're in a very low rates environment where there's a tremendous amount of demand for government debt, and, that probably government spending in this type of environment is less inflationary than many people would think. But I think there's lots of, lots of uncertainty around that.
Right. So you come very close to what I describe as there's the part of MMT that I like to call the descriptive part, which is basically the plumbing and how a modern fiat-based monetary system works. And then the prescriptive part, which is basically based upon those assumptions, what do you do? And I'm in the same camp as you, because I kind of look at this and say, well, those things are all political decisions about once we understand the economy and how it works, we can make a decision about what we want to spend on and how we want it to organize our society. But that doesn't make the first part. You might disagree about the decisions that many people that have grabbed hold of the MMT moniker, like AOC and stuff, what they want to do with the money. But that doesn't make the plumbing side of the part of the equation wrong. And I'm super interested to hear you say the fact is that's you just can't argue that. And I was just wondering, why do you think so many economists have trouble with that part of the plumbing portion of it and want to push back on it?
It's a good question. I mean, I think that, a lot of economists live in a pretty rigid world of theoretical models, which, have some limited applicability and are useful organizing concepts, but just at the end of the day don't have good ways of thinking about these kind of questions. I think that for the most part, folks actively involved in money markets, I think probably understand this stuff as well or better than academic economists do.
Yeah, I would completely agree. And like you look at the guys that Warren Mosler and a lot of the MMT proponents are actually guys that understand the plumbing of the finance system better than the people that are actually making those decisions.
Yep, that's probably right.
Yeah. Okay, so let's go on. I saw another tweet that I had to kind of push, ask you about. It says the dark secret is that 99% of what people tell you is artificial intelligence is just linear and logistic regressions. Why don't you tell us what you mean by that and kind of what that might mean for the markets?
Sure, absolutely. I mean, I think that there's a few different angles on this, but I think one of the core things that I was alluding to in that tweet is that AI and machine learning has become a very, sexy and trendy set of buzzwords, right? Arguably, maybe more so a year or two ago than right now today. But I think that's pretty uncontroversial. And as a result, it's sort of attracted every type of, organization that's pushing a product to sort of try to tell you that their product has AI and machine learning in it. And
right.
This is enabled, I think, further by the fact that partly just by, divergences of disciplines or whatever, many of the old basic tools of statistics are things that, that if you open a textbook on machine learning, like ordinary least squares regression is usually chapter 1 and logistic regression is chapter 2 of a textbook on machine learning, right? So those are obviously things that statisticians and, basic practitioners of empirical research have used for, 50 years. But now people sort of feel comfortable calling them machine learning because machine learning is cool and, and machine learning has a lot of overlap with, statistics. Even like neural nets, which we think of being heavily used more recently, are a very old, technology that has been, used in many contexts for a long time. So I think point one is this is really it because the space became sexy. It attracted lots of people saying that what they're doing is AI and machine learning. That's just not in any kind of deep sense of the way that people think about like cutting edge technology or new things. Number two, so, the really truly modern techniques in AI and machine learning, the types of things that were much more recently developed and being used heavily by like the big tech companies in image recognition and so forth, are very powerful technologies, but they have very specific types of problems that they were designed to solve and are good at solving. And those problems don't usually have anything in common with trading and investing type of problems. They might have much more parallels with certain kinds of like back office task automation, problems that we face in finance and things like that. But generally speaking, these types of tools are extremely good at, think of them in a sense as very, very highly nonlinear, regressions and category, both in categorization and in prediction. And very highly nonlinear tools are really good for fitting complex relationships when you know that there's very little or no noise in the data and that the data set is truly like identically distributed. So a great example is, why there was a big furor over training machines to play Go. So the AlphaGo kind of revolution. So this is the kind of thing that, that neural networks are designed to be extraordinarily good at, because just think of it as that you can build a data set of infinite size by having the machine play itself in Go. That data set, every game of Go is very tightly structured. It has an exact set of rules, and that exact set of rules is very simple and it doesn't change, right? And so every observation is a truly unique observation. And you can build a massive data set and sort of train in all kind of complicated ways, and the machine can teach itself really well. But that doesn't have anything to do with finance and to trading. And right, the world, right, we live in a world where data is non-stationary, which means, look, over time, there's tons of unobservable stuff going on in thinking about what's happening to stocks or to volatility or to the macroeconomy. You don't know what the right model is. The right model is incredibly complicated and you have no idea. And it's changing over time in ways you can't observe. And if you just fit like a really nonlinear thing to a bunch of financial data and then extrapolate it out into the future, you get absolute nonsense. So generally speaking, you saw a wave of artificial intelligence, hedge funds launched and funded, starting a few years ago because this was really exciting and cool and got a lot of interest from allocators. Many of them either failed or effectively kind of have produced a return stream that just looks a lot like more typical quant factor type of return stream. And so I think, a lot of the large, sophisticated institutions that big quant shops looked very heavily at a lot of these types of technologies, and they use them very heavily, again, in various kind of intermediate processing steps. But this naive notion that like you put all the data in and then the machine sort of spits out like the trades, I think is extremely naive and is not what you see actually happening anywhere.
So I see that AQR recently laid off 15% of their staff. Ray Dalio, I know he's not a pure quant guy, but he had a tough year last year at his Bridgewater. Do you think that we've hit peak quant?
I think all of these things kind of come in waves, right? It depends on, there's many different types of quant. I think AQR is emblematic of your academically influenced factor style investing, right, which is one big area of quant. And I think the question, they're very smart folks. The question there is really just as these approaches become very, very popular and the assets invested in, factor bias strategies and market neutral factor strategies grows and grows and grows, like, at what point does that erode returns in the space? And I think it's a hard question to ask to answer a priori, but I think that's likely part of what's going on there. So it may be that there's some predictive power of that for the future, and that space underperforms. I don't know the answer. The other side, Bridgewater is quantitative in the sense of, they're pulling in lots and lots of inputs and trying to give their big decision makers, a lot of information. But I think at the end of the day, that's not a quantitative process firm. There's in terms of the way the portfolio is put together. They have a great track record. They've done well for a long time. A little bit less well more recently. Depends on what you're talking about. There's the risk parity types of products, obviously, which are very large scale and very separate from the hedge fund. Part of it's also just scale, right? I think pure alpha is quite big, and it's tough to be a relative value type of absolute return hedge fund managing many billions of dollars, right? Just the opportunity set of what can you do to take advantage of markets at that scale is different than at the $100 million, $500 million scale.
Right.
But then another part of quant is think of the higher frequency, folks like the Renaissances and Two Sigmas, and they're crushing it, and they've been crushing it forever, and they haven't slowed down at all. And I don't think they're gonna. So.
Really? So what do you think is their secret sauce for that? Right.
Well,
what do you think is their secret sauce for those guys?
Well, I think ultimately when you understand the types of things that they're doing and how they make money, this is my view. Having but I certainly don't sit inside one of those firms. Is ultimately most of the alpha generation in those firms comes from effectively providing liquidity, intradaily and relatively high frequency, right? So it's these are not factor strategies and kind of medium term strategies where they're longs in stocks or shorts in stocks. The big money makers are the higher frequency algorithms that are detecting large trades going through, and taking the other side of them appropriately, that are effectively providing liquidity in options markets, when they see, flows coming through and so forth, right? And those type of strategies are, very technology intensive, very scale intensive, require, doing it right and not screwing it up, 99.9999% of the time. And I think that, there's big economies of scale in that, the same way there are in big tech, right? So I think you're seeing the same way you have in big tech, quite a lot of consolidation and concentration of just a few giant companies that are hard to challenge. I mean, that's happening on that side of quantitative finance as well. And I don't think that's going to go anywhere, right? You can't, this idea that you're going to democratize, quantitative finance and have a couple of guys sort of in a garage, challenging Two Sigma on that type of trading, I think is just not realistic.
And so do you think that those are mean reversion strategies and they're providing liquidity and there's not front running of large orders, like not front running, that's not the right word, but momentum based strategies, like trying to, identify momentum and grabbing hold of it? Like, do you think it's more liquidity providing or is it a combination of both the kind of
I think it's a combination of both for sure.
Right. So it's not just, they're also trying to identify momentum and push it along because they know it's headed higher.
Yeah, I think that's correct.
Right. Let's talk a little bit about risk parity. One of my pushbacks about risk parity is that it seems to me that in this kind of last 30 or 40 years of bond interest rates going down in a disinflationary world, that it's basically just an excuse to be able to lever up bonds, with the stock market. And one of the things is that a lot of it is based upon the negative correlation between stocks and bonds continuing. I was just wondering what your kind of thoughts about that is. Do you think the strategy is going to continue to work in the decades to come?
Sure. So I think, certainly it's true that you will not be able to replicate the exceptional performance of the fixed income leg of risk parity type of strategies, in the next 10 or 20 years relative to, say, starting in the early 80s or mid 80s to now, right? Because of, as you said, interest rates coming in and in and in. So at a minimum, you're not going to perform as well in that. Where does the negative correlation aspect come from? Really, ultimately, I think the negative correlation between stocks and bonds, comes from the flight to safety aspect that exists in bonds, that's existed pretty regularly outside of the stagflationary, inflation rate spikes of the 70s and 80s. I don't think that you'll likely get back to, sustained, positive correlation between stocks and bonds, absent some significant, rapid yield breakout and inflationary breakout. I think that type of a scenario would probably do it. I think whether or not we get that type of scenario, is yet to be seen. I think I think that what economists should admit, and I think probably more traders than do, clearly the relationships between, employment, uninflation, central bank policy are complicated, and probably we don't understand them very well, right? Because not very many people have gotten right the relative moves in these different variables over the last 15 years, kind of pre-crisis and post-crisis. There's certainly an argument out there that, that there's going to be structurally slower growth in the world going forward, especially in developed markets where you have, really adverse demographics and, going to be fairly perpetually increasing demand for fixed income securities. And unless you were to have, again, some type of severe adverse shocks that, created a big inflationary breakout, it's not clear that goes the other way. So anyway, long-winded way of saying, I think that the unusual scenario is more really high rates. Historically, that's quite unusual. We got there in the, in the 70s and 80s. Whether we get back there, I think that's more of a surprising negative shock than kind of the expected, move, right? I think that, but that said, certainly risk parity is not going to be making a bunch of money on duration risk from, bonds going, from rates going from 15 back down to 2.
Well, let's take the other side of talking about high rates. Let's talk about extremely low rates, and let's go and talk about negative rates in Japan and in Europe even more especially. That's been something that if you'd asked us, most people 10 years ago, whether we could have ever imagined the Boon trading at minus 50 basis points, we would have said there's no way, that doesn't make any sense, yet here we are. What is your take about what's happened there, and what are the implications and what you see going forward in Europe, specifically on the monetary policy side?
Yeah, I mean, a few different things. Certainly you're right, but I don't think you would have found a lot of people predicting, sustained negative rates, and not just in the very front, but even, out at different times, even out into the 5 and 10 year points in Europe and Japan. I think, obviously policy is one key driver of that. You do have, a school of central bankers that, view negative rates as stimulative on the margin. And I think, my take there, if anything, is more just, I think there's not a whole lot of evidence that, of strong sensitivity of economic growth and risk appetite to marginal changes in interest rates around here. I just don't think they're a big driver of anything. Whether rates are positive 50 bips or 0 or negative 50 bips, what is the delta of the real economy to that? Really, I doubt it's very high. It certainly doesn't seem like it is from the evidence. But again, these are hard and sort of empirical questions to answer. You don't have the counterfactual. So it does seem like, from a policy perspective, pretty unusual experiments that it's not obvious are going to have much, positive impact. On the other side, just in terms of market conditions at the long end, I mean, Europe and Asia certainly have, and the U.S. to a lesser extent, right? You do have lots of effectively forced buying of those securities, right? Because one, European insurance companies, European pension funds, Japanese pension funds, you have a certain amount of fixed income securities that you have to hold, either from a regulatory perspective or just from a policy perspective. And whether the yield is 2% or 5% or negative 75 basis points really doesn't matter much. You're still a buyer. In many cases, the cross-currency basis swaps are such that even if a Japanese investor had the opportunity or the ability to go buy dollar bonds instead, as long as they had to hedge that FX risk out. They can't really get an advantageous yield doing that. So, part of the issue here is, even just from a market, there's the government policy side, but there's also, out there in the market, there's lots of folks who just have to buy these securities regardless of the price, right? And so on the margin, it's not clear that, there's that much impact from a, value buyer perspective. Okay, so maybe macro hedge funds aren't going to own those bonds. They're going to, buy something else. But a lot of the big money, fixed income buyers in the world don't have a choice set to move out of instruments that are trading at negative rates.
Right. So let's try to bring this to a close a little bit and figure out what do you think the market is missing, or the next big opportunity that kind of is underappreciated by many traders and investors?
Certainly a couple of different areas. I mean, certainly from our perspective, we think about option markets and what are the really big flows in option markets. What's everybody doing? One of the biggest, if not the biggest, underlying trend in option markets and equities is that, while in the old days, short-dated options were expensive and everybody was structurally a buyer of short-dated options because they were worried about, what might go wrong in the world, say, immediately after the credit crisis. These days there's really massive selling of short-term near-the-money options, like on the S&P, for example, and there's really only natural sellers. So, most of the large pension funds and asset owners in the world are now overwriters of calls. They're now underwriters of puts, often on an equity replacement basis. So they'll, cut a $100 billion pension fund might cut its equity allocation by $10 billion and replace that with just selling 1-month puts as a yield generation and path diversification mechanism. And I think they're looking at 30 or 40 years of backtest returns on, making the decision to do that and of how much capital to allocate to that. But I think what's happened as a result is just very dramatic changes in risk premium associated with selling options, dramatic steepening of the volatility term structure. So very short-term options trading very cheap, relative to longer-term options. And I think that, most of ordinarily, maybe there would be more folks out there trying to take advantage of that. But, for many years, those type of options were very expensive, and they do pay, it costs you money to carry them. Just, if nothing happens today and you own those options, you're going to lose some money on option decay. And so most of the types of folks who, liked to pay option decay, got fired or lost their jobs or their funds closed down, 5 years ago. So I think that there's a big opportunity set around that, depending on what style of investor you are, what type of portfolio you manage, what role those types of securities can play in your portfolio. But again, very, very price insensitive and large scale selling of, by big institutions that aren't really thinking about, the nuances of pricing.
Wow, that's really interesting. Okay, so one last question I'll leave you with, Ben, is if you had met yourself 20 years ago, what advice would you give the younger Ben from the little bit older Ben? 20
years ago, wow, that's good. So, I mean, I think that, well, at the time, I suppose I didn't even know what I was doing at all. I probably would have said study computer science instead of economics, because I was at Stanford in 1999. That would have been pretty cool. Take that job at Google instead of going to going to try to manage money. That would have been a good one.
That would be, so you're actually in San Francisco, and why don't we just could you leave us with your thoughts about what happened, with the WeWork and what you see around you, and was that kind of the top that we've seen in the private equity unicorn? Was that the pricking of the bubble, or could we still get even more kind of inflated from here?
No, it's a great question. So, Silicon Valley is a super interesting place. I mean, I think WeWork was really a manifestation of, a huge trend that started, 3-4 years ago, probably even a little bit longer now, which was companies, there being so much money in Silicon Valley and so much venture funding that was so easily accessible that, many companies and startups that really were not in any way, shape, or form technology companies, rebranding themselves and their pitch and their language as technology startups. So, we were actually, if you even think back to the Blue Aprons of the world, right? That was a very sexy, exciting space, and there are all these big IPOs at very high valuation. When you look at those businesses, and you're like, but you put food in boxes, and then you got guys in a warehouse, and then they ship it around, and you have a website. And what does this have to do with technology, right? But they were able to get tech investment, and then tech multiples, an IPO at tech multiples, and that was pretty super for some folks involved, right? So that built, and SoftBank got very heavily involved. And if you talk to local venture capitalists, SoftBank really was the elephant in the room, where just there was preposterous amounts of money on a scale that Silicon Valley was not used to at all, backing these type of organizations with very few questions asked and encouraged to, really think big. So it was then you imagine what Blue Apron could have been if somebody had showed up early in their life cycle with, $1 billion and said, no, think big about all the different things you can do, right? And that's what WeWork was. And, eventually, and those companies were, staying private for a long time, for various reasons, right? It made things a lot easier for everybody involved. There were not, you didn't have public markets investors asking questions about whether you were going to make money or not. You could keep marking the valuations higher on more SoftBank funding rounds, but at some point, obviously, those folks had to come to market. And I think there was a rush to public markets as public equity markets started to get much more jittery in 2018. And WeWork was a great example of public markets investors, at least doing a little bit of homework and sort of calling the bluff of private markets, on this. And I think that it really does appear from where I sit to have taken the SoftBank bid out of the market for these types of startups. So SoftBank's come under a lot of pressure. They've been pulling on signed deals and not funding them. They've been we'll see kind of where that goes. But I think that ultimately the valuations of many of the decacorns and the unicorns in Silicon Valley space, in these tech adjacent industries where you really don't have a story for how this company could ever be worth, $500 billion. Really many of those companies, I think, you're seeing down rounds, or you're going to see down rounds. You might see valuations cut by, very dramatic multiples, because ultimately that's the thing that justifies overpaying, in a Series C is the idea that somebody else is going to overpay more in a Series D, right? So I think that process has begun. I think it'll take a while to play out, and its implications, there's not going to be some kind of a systemic result of that. But a lot of people who think that they've made a lot of money in venture fund investments, it'll turn out they actually didn't.
Well, it's fascinating stuff. Ben, I thank you so much for coming on. Why don't you tell people where they can find about you and your firm, and learn a little bit more about what you do?
Oh, sure. You can find me on Twitter at Benn Eifert. You'll unfortunately mostly hear about whatever mischief my kids have been up to recently and what they've destroyed and so forth. But you can, we're a private asset management firm that doesn't have much of an internet presence or anything like that. But we do have a website. If you Google QVR Advisors, you'll find us, and you're welcome to submit a contact form.
Right, and I highly encourage everyone to follow Ben on Twitter. He's a terrific follow, so it's BennPeifert. Anyways, thanks again, Ben. It was a real pleasure having you. So joining us now is Tony Greer. Happy New Year, Tony.
Hey, Patrick, Happy New Year to you, man. How's it going?
Oh, it's going great. So those of our listeners not familiar with Tony, which you should be, but from the TG Macro, and we have his regular segment called the Navigator launch. And Tony, it's the new year. The markets are buzzing here, and we got to get you online here and share your thoughts as what's going on. What's your take on all of this?
Yeah, well, I'm happy to share, Patrick. I think my take on this is going to be about respecting the dip in the dollar that's taking place. I feel like in 2018, 2019, we're just up years for the dollar, and they couldn't break down. It feels like this year we're seeing a little bit of strength out of Europe, and then that's just happened recently. We've seen the Europe and the euro and a couple of other currencies trying to turn up against the dollar, and I really want to respect that because those currencies include, everything from the euro to the pound. With the Brexit scenario, the Aussie dollar has tried to turn up a couple of times here. At least it's leveled off against the dollar. So I want to respect those other currencies at this time. And it doesn't make me a dollar bear. It just, as a framework, I want to use a dollar pullback scenario as my framework because I think it feeds into a little bit of headline inflation hitting the tape. It feeds into having a strong euro and that propelling potentially the commodity index higher, which is part of my base case scenario that I think could occur this year finally. Because, look around, Patrick, it's a liquidity game right now. The commodities are starting to perk up. Gold is rallying clearly. Oil is rallying, for a number of different reasons. We could say it could be rallying, but, oil's been firm as well. And so I'm going to look for a little bit of inflation here in the U.S., a little bit higher rates led by Europe. And I think the 10-year is a sale. I think 10-year treasuries are a sale. I feel like yields we're going to have some time above 2% coming up here. What do you think? Sorry.
Yeah. Well, no, I was just going to ask you, one of the big things we talked about, we made our little 2020 bold forecasts in our last episode, and clearly mine wasn't bold enough by what many of our listeners were saying. But one of the things that was a part of my narrative was the fact that I didn't think that this reflation impulse that you're referencing here was going to last much more than maybe the first quarter, like somewhere in the first half, we're going to have a flip. I mean, you're obviously not a big dollar bear. You made it clear. So are you in that same camp? Do you think that we're going to get a little bit of inflation here, but this is not the big one. This is not the big turn in your mind, is it?
No, I don't think so. I mean, I still think we could stay long gold within that conversation, but I think I don't think it's a big dollar turn either. I think it's just, it's time for the other currencies to get some attention. Literally, it's been a strong dollar environment for 2 years now, and at least they're starting to see some signs of a turn up in German industrial activity, and then just literally this week, and things like that. And so that's helping their rates break out a little bit. I feel like if you see, German bonds go into, at least yielding zero or a positive yield or something like that, there'll be some flow into Europe, and there'll be some flow into the stock market because it'll just look like a healthier market. And I think that could propel the euro, which could then therefore propel commodities or at least be a tailwind for commodities this year.
Right. And so here we have that 10-year Bund yield, which is at minus 20 basis points right now, right?
It's an interesting level, right, Patrick? It's a 2016 low.
Yeah, it is. And what is interesting, so you're thinking more like this 2016-17 scenario, which is that, just for like a year, the yields just kept rising a little bit. I mean, do you think there's going to be sustained higher interest rates in Europe, or is this just a reaction from an incredibly crazy drop in yields throughout 2019?
Yeah, well, I'm not, I wish I could be an expert in what I think is going to happen in Europe. I try to just react to what is happening. But I will say that I've been impressed with at least some of the data has held in there. If you look at the European economics, city economic surprises index for Europe, it's gone from like minus 80 to plus 40 because their data has been beating on such a consistent basis. So that's just at least something to take into account. And if we see some leadership there, at least you'll see some money flow, and that should be relevant or at least obvious in the FX markets. I just get excited about that Bund yield chart because, we've had this breakout above all the moving averages. We're starting to see the 50-day cut up through the 200-day now. And that generally is a, bullish signal going forward. So, if we get back above this minus 20 basis point rate, then I think that, you'll see the treasuries and sovereigns around the world start to back off. We can make a case that we were, like Kevin was saying, that we were in a bond bubble last summer, with that humongous pool of negative yields. And, literally the bond market went up every day. And that was, in fact, a bubble that I think we're rejecting. So we'll know soon enough.
Right. And so what's your thoughts on the 10-year yield then?
Well, I think everybody here in the U.S., I think the part of the reason, put it this way, this has relation to the stock market. Part of the stock market rally is obviously because of the liquidity pump going on at the Fed, right? But if you look at positioning going into the sort of last quarter of this year, portfolio managers were really expecting a recession, right? The curve,
Yeah.
the yield curve had just been inverted. The alarm was sounding. We talked about it on the show where the yield curve made the cover of Drudge magazine, Drudge Report website. And I was like, if that's not a signal that this might be the bottom of of yields and the bottom of the curve inversion, then I don't know what is. And so we've migrated out of that. I'm not going to say that it's never going to go back there, but the way the data has been going in support of higher rates, I still feel like the bond market is behind, and should have sold off even more, given where we're going. So, with the economy, and I think that the economy is just sideways to steady. There's no real emergency to talk about in terms of the U.S. economy, other than it's in pretty good shape.
Right. So the interesting part about you were mentioning the yield curve, and I'm just pulling up a chart right here. This is the 2s10s.
Yeah.
And obviously we've had a little bit of a steepening, obviously, since July. I put a weekly chart, so this is going like a 5-year time frame.
Yep.
Now, what I've heard many people say is that forget the flattener, it's about when it starts to steepen that actually is the recession signal. That's when the scary things happen. Now, but there's numerous times though when it just starts to steepen a little bit. Just it could be like a bit of a bear steepening, especially like you were talking about here on the 10-year.
Yeah.
But it doesn't end up being the big one. And so the question here is, do you think that we're heading right back down to the zero line on this, or what's your intuition how this could potentially start to play out here?
Well, my idea on how it starts to play out has to do with the fact that the recession, I don't believe the recession is coming anytime soon. At least I can't find any concrete evidence of it. So if I don't believe that, then I feel like that, I also proved in my note that, the yield curve was inverted for the shortest period of time preceding any prior recession ever. So the yield curve was inverted for a number, I don't know, it was a number of days you could count on. I don't know, it was 50 days or 35 days or something like that. Whereas in prior recessions, the yield curve was inverted for like 9 months, or 6 months period of time. So that at least during that period of time, you already started seeing the data start to turn, and then you would have the yield curve go higher and then bad data come out. But we haven't seen the bad data at all yet. We've only seen this crazy, snap into negative territory in the yield curve, which could be explainable by a number of different things going on in the Treasury market. I mean, God, what's been going on with QE and then at the repo window? Who can really eloquently explain everything that's going on in the Treasury market right now? I don't know anybody.
Right. Right. You know what's interesting about the that yield curve and the steepening. I wanted to go back to 2006 and 7, and what was interesting is that if you look here on the chart, it was actually all the way back in 2005, at the tail end of 2005 into the start of 2006, that the first part of the inversion happened. And for almost an entire year through 2006, including one false start up here, the yield curve stayed inverted or down at the bottom end. And so it's hard to make a signal out of it. I mean, it took almost 18 months for the real steepening to kick in. And this is the interesting part, is that while we've seen us come off from an inverted curve, what if this doesn't even start to steepen until 2021?
Oh, man.
Right? Like there's, to me, it's like it's not a tradable pattern on the very short term.
No, I agree with that.
Right?
It's really not. I'm not, luckily the curve is not an instrument that I'm out there trading actively. It's just something to keep an eye on, you know?
All right. So listen, I want to move on because a whole bunch of our listeners, I'm sure, are dying to find out what you think is what's going on here in the stock markets. And I mean, here I'm going to pull up the S&P 500, but we've obviously had a pretty hot market since October. This S&P's been ripping for, just north of 3,000 all the way to just barely to it's approaching 3,300 slowly.
Yeah.
And that's a pretty solid 10% rise. And so, what's your take here? I mean, does this thing still have a little more to go, or are you starting to get a little skeptical here?
Well, I put it this way. I played the breakout through 30-30, right? You can tell right there, going back to sort of November, December, that's really when I got on board, right? That saying through 30.30, the market can run here. I thought it would go to roughly 32.50, and I'm on the tape saying that, so I don't feel bad, like I'm making this up. So now that we've gotten here, and we've got an event on the tape between the United States and Iran, I have taken a lot of chips off the table aside from my aside from my energy stocks. But I feel like the only, put it this way, we just lived through this, potential Middle Eastern conflict situation, and it was barely a hiccup because the Fed is providing so much liquidity at the repo window and basically in as much as is necessary. And so that money keeps finding its way into the stock market. So while I can stay bullish within a secular trend, and I can say, I wouldn't buy new longs really up here on this extension. If the Fed is going to keep the liquidity pumping at the repo window, I'm certainly not going to short the S&P for a trade. That's all I'm saying. I can't pick a number on where it stops. Overbought stays overbought. And, it still looks like we're in that kind of a scenario. And so right now I'm literally trying to be as patient as I can because it doesn't seem like making new purchases up here on stocks that are at least making new highs is a good idea. So I'm going to sort of let this play out and see what happens.
All right, so Tony, let's talk some individual stock names. Is there something that you're watching? What's on your mind here?
Like I said, I like the energy stocks. I love the fact that there are some sentiment bombs out there, Patrick, right? There are some things where, like in Europe, they want to stop lending to the fossil fuel companies, right? And that's just like, that sounds insane to me. Over here, you have Chevron writing down massive numbers of shale assets, natural gas assets. And I feel like that's sort of, this is, at this point, with the way the stocks have reacted, that's kind of throwing the baby out with the bathwater, these write downs down at these levels. So I'm not saying that it's definitely going to hold. I don't have a crystal ball, but I like the way that for the last half of 2019, it seems like energy stocks went down every day, except they never made a new low. So that was interesting to me where it seemed
they've been bled out.
Yeah, it seems like they were bled out.
What's interesting, there was a stat out there. I didn't do the calculation myself, but something like the entire S&P 500 energy component has the same market capitalization as Apple.
Exactly.
Now, it's been slaughtered. Right?
Signals like that are just for me. I have to put some money in the market when a sector is that hated and I can't get there.
So that's a value proposition, right? Like that to buy a cheap asset. But do you think technically we're here where like in the first or second quarter of the year that there's going to be some tailwind here that could see these things have a legitimate pop? Like what's your kind of technical take? And is there a particular name you're watching?
Well, technically, like of the individual names, I like the potential bottoming action in Oxy down here at Occidental Petroleum. That stock is off from $90.
I'm long it, so that's fine by me.
Oh, okay, good. It's just making all the right moves now. It's finally crossed both moving averages, the 50 and the 100-day, and it's on its way to the 200-day. And sort of, that's a stock that I have as a sort of Texas hedge to my XOP. And I'm hoping that both of them can get above their 200-day moving average, and I can add for a little bit because I can see a scenario even where if the stock market backed off, that maybe energy stocks might not get beaten up that badly. It seems like if they're going to come for the stock market, they would come for technology and semiconductors and social media, which has just been flying in the last couple of weeks. So, that's just a gut idea. I don't have any evidence to prove it, but I don't mind staying long energy stocks through this.
All right. What's your thoughts on the way things have been developing in those canopy stocks, or not canopy, the cannabis stocks like Canopy Growth?
Well, yeah, they've been disappointing, and I'm trying to stay on the storyline. I'm impressed with the way Canopy Growth has similarly been bottoming for the last 3 to 6 months. We had that spike low down below 15, I guess, sometime last fall. And the stock is
looks
really
looks a little bit like an inverted head and shoulders, almost like a little bottoming formation.
Yeah,
doesn't
exactly.
It? But it hasn't broken out.
No, it hasn't broken out yet to the upside, but at least it's it's holding this level. I want to be positive. I thought there would have been a bigger short covering rally from the Mario Cuomo announcement that New York is going to legalize within the next year, but there was no such luck with that. I think everybody maybe was expecting that, and so there was a non-reaction. So I don't really have a great answer, Patrick, for why they're sideways. I really haven't fully engaged in that sector at all since I stopped out of everything. And that was the sort of thank God I stopped out of everything kind of deal. And you sit there and wait. And usually once you make the sale, you're even more hesitant to get back in again, because you're not sure if the bleeding is over. So I'm literally, it's hard to keep your hand on the trigger trying to get in when you're being really, really cautious in the sector. So I don't know. It seems like we've got a supply issue in the cannabis. So we'll find out soon.
All right. Well, Tony, listen, if anyone wants to find you and learn more about you or follow your Morning Navigator, where can they find you? Give me coordinates.
Sure, man. You can sign up for a free trial of the Morning Navigator at tgmacro.com, right on my homepage. You can find me on Twitter at tgmacro, or you can send me an email at tony@tgmacro.com, and I'll get back to you as quick as I can.
All right. Well, Tony, thanks for the update, buddy, and look forward to having you back on next month.
Patrick, you're the best. Thanks for having me, man.
All right. Cheers.
Cheers, bro.
Okay,
all right.
Okay.
Let's talk some charts.
Yeah, our new favorite segment, Talking Charts with Patrick.
So I put together a couple of fun things I just wanted to talk about, or at least bring to our listeners' attention. And so the first thing I threw on the chart of the S&P 500, which just after that Iranian situation popped to a higher high and pushed higher. But what first observation I wanted to make was just looking at what happened with the Russell 2000 small caps relative to the S&P. And what's particularly interesting is the Russell had almost no bullish response in the past few days. And so the S&P, while it's been ripping on a lot of those mega caps like Apple, the Russell was very non-responsive. And one of the more interesting things to watch in the coming days and weeks is will we see a divergence here? I mean, is the Russell going to catch up here, or is the Russell signaling that this rally doesn't have any bite?
Right. Do you think that that's kind of indicating that the market is getting more narrow? And that this is just
for sure it's getting more narrow, but that doesn't 1 or 2 days doesn't make a trend. And so one of the things that I'm going to continue watch over the next week is whether this divergence continues. Has the Russell really run out of momentum, or does it just catch up and break to a higher high and join the party, right? Another really interesting chart that I was looking at was what's happening in the German DAX. And that really does look like it's been breaking higher, doesn't it? Like that's a nice bull breakout. Obviously, it could always end up being a prairie dog and drop
a noble
back
animal.
below. A noble animal, that is, yeah.
That's right.
But by all accounts, this is something that flashes green on every trader's chart screens when you have a gapping break to a higher high. And under most circumstances, like just as an example, when back in October when the German DAX did that kind of gap above all of these highs, it really brought in several weeks of strength that saw almost 1,000 points to the upside. And one of the more interesting things to watch right now is this a breakout? Is this for real? And painfully, one chart that hurts me a lot is to look at Deutsche Bank, because there's a steak dinner riding on this, isn't there, Kev?
There is. That's right.
And
I didn't want to bring it up because I wasn't going to talk about it. I didn't want to anger the market gods.
Well, you don't have to anger them, but it it doesn't look good for me right now. I mean, it still has to tack on $1.50 in order for that $10 tap to put a stake in front of you. But it certainly does look like that Deutsche Bank's been basing for a better part of 6, 7, 8 months now, and with this basing formation, if these gaps higher are breaking it out at the same time as the German DAX is breaking out, maybe the European markets have a little more upside than the U.S. markets do.
We could only hope.
All right. Another interesting chart that I wanted to point out is how bullish the South Korean Kospi's been trading. And while it's been one of the mega bears throughout majority of 2019, it has actually been behaving incredibly well over the last 3-4 months. Every dip's been bought. It's been breaking higher highs. It looks like a very healthy chart. And one of the things that I'm going to be watching into next week, do we not only break to a little bit of a higher high for the month, but also do we break out to a 52-week high above all of these kind of highs that occurred in early 2019? And that's, I think, something that we want to keep on the radar.
That's do you have
any insight? Do you have any insights on that?
No, but it's interesting to see you kind of bullish on these things, and I'm thinking the charts must be changing. And that's
it's not about bullish. It's behaving very bullish. I'm just an observer, right? It's right. This chart is behaving very well, and it'll be interesting to see whether there's follow through on that. Another now we talked Apple last week, so I'm not going to beat this one any further, but it's just continuing, right? Yeah,
it's shocking, Patrick, because this is the world's largest company, and for it to be doing this is just shocking. It gaps higher every night, and every morning you get up and the analysts are all falling.
They're all falling off.
That's right, and every analyst tries to be the highest on the street, increasing their targets, targets. This is just. Patrick, you asked me about a famous Jim Rogers saying, and why don't you tell the listeners about
what it was? You say it. You're the one.
Okay, it's Jim Rogers often talks about the top in the gold market, and he says how he missed it by 2 days, and unfortunately, it sounds like he almost top ticked it. He said, unfortunately, it was like $200 before the actual high, because often the last 50% of the move is in the 5 or 10% of time.
Yes.
And to me, it really feels like it's just gone parabolic, and
it's parabolic. And what I thought was really interesting is that there's a precious metal that is looking very similar to the Apple chart. And what I wanted to do is actually overlay them. What I was going to show is the palladium chart. Look at this, and it's just finishing a measured move to the upside. But what I wanted to do is just overlay Apple on here. Now, by the way, there is no reason to suggest that there's a
relationship
between the two, but they have both been going parabolic. Isn't that interesting that we're seeing that a precious metal like palladium is actually parabolically rising at the same time? Isn't it amazing how you can build a correlation to these?
Yeah, and Patrick, you're kind of pushing into a wound for both of us, because we were in a stock, and we didn't talk about this on the podcast ever, but we were both into a stock that was one of the few palladium mines that out there, North American Palladium, and I thought it was going to be a mini bagger for us, and unfortunately it got taken out. And it got taken out at a decent premium, but unfortunately, we're no longer benefiting from the upside of palladium. Yeah. So you knew this was going to happen once we got taken out, Patrick.
Sure. So what will be interesting is that same concept of a parabolic rise. Are we going to see some sort of blow off in palladium? It's going to be one of the really interesting things to watch. The other thing I wanted to touch on was the relationship of and the divergence of Amazon from the FANG. So this is here a chart of the FANG index future, which it's FANG plus, because it's not only just the FANG stocks, it's Facebook, Apple, Amazon, Netflix, Google, Alibaba, Baidu, Nvidia, Tesla, and Twitter. So there's 10 stocks in the future, but this is like a parabolic the FANG stocks are just going straight up. But what's amazing is Amazon, which is one of the larger market cap ones within there, has just not ever taken off. I mean, it's struggling to even beat 1900. And it's just out of these FANG stocks that have been doing this face-ripping rally, Amazon has not participated. And I mean, can we see a blow-off in FANG without Amazon even getting above 1900? Like this is really interesting, and more importantly, if the FANG stocks peak out and start to sell, does that mean that Amazon is going to be the dog shit and it's going to get hammered heavily on the downside? If it can't rally during the big melt up, then it's got to be the weakest stock of the group, and it's going to get hammered the other way. What do you think?
We were talking about this with the boys at work actually, because we were noticing the same thing. And Amazon has just been shit in the bed on a relative basis. Like, if you look at it, it's terrible. And I think that it's going to be the one that leads on the way down. It's one of my favorite. Like, if you're going to lean on something, lean on the weak one. Instead of trying to go out and short Apple and stuff, go short this thing.
Yeah, it
doesn't gap ever up every night on you like Apple.
No shit. The last stock I want to leave our listeners with, I wanted to just touch on Costco. And so Costco has had an amazing 2019 run, right? There's this beautiful upwards channel that's been running more or less throughout the majority of 2019. Now, it peaked out in the summer in August. And for the last 6 months, it's been just sloshing sideways. Often traders identify that as topping formation, start looking for, head and shoulders patterns or double tops or other things like that. But recently, just the other day, they came out with the news that they had strong December sales during the holidays, and the stock gaps higher. And whenever a stock gaps higher like this, to me, it's the big tell. It's the big tell. Either A, the bulls are going to grab hold of this and we're going to rip above 300, hold there, and then it can open the window for an advance at 320 or 330 on the upside of Costco. But at the same time, whenever you have a big consolidation and a news event like this that is entirely bullish, gaps it higher, if the sellers use the strength to do a selling and then they basically hammer right back down to 290, then it actually solidifies a top for Costco. And I'm not trying to actually predict which one will be, but the fact that we had this news event and this gap, we're going to have a big tell from Costco in the next week or two, I think.
Yeah, I kind of viewed it a little differently because I could see a situation where if the whole market sold off, this thing might go drift sideways to down, and you might say, oh, that looks like it's topping formation, but on a relative basis is actually outperforming. And if I had to guess what's going to happen going forward, that would be my guess. Right. Is that Costco struggles and goes probably sideways to down, but not nearly as much as the rest of the market. So I'm bullish Costco, but not bullish on an absolute basis, bullish on a relative basis.
Well, for me to be bullish Costco, I want to see the bulls hit above 300 and hold it above there. I mean, if we see that, then that actually is very positive price action. And then we'll be looking to see whether they can make 52-week highs with it. But if we're back down to 290 or lower within a week or two, I'm a seller actually. But I haven't decided yet.
Okay.
These are the things that we're watching, and we'll keep a close eye on it. Anyway, that's
awesome
talking
stuff,
charts,
buddy.
So
talking charts with Patrick. Make sure you tune in every week. Same next week. Same bat channel. Same bat place.
All right, let's move on.
Okay, this week in trading history, Patrick, you're going to get 2 in a row, buddy.
2 in a row.
What do you got for us?
So now. A little bit different because normally I actually have a specific date. So some specific thing happened on a specific date in history. But, no matter how much research and no matter where I looked on the internet, I could not find any months or even days associated with Leonardo Fibonacci. So I figured at the start of the year we would just give him lip service. There's very little known about Fibonacci's life. He was born sometime around 1170 AD and died around 1250 AD. But there's no months or dates associated with any of his history. But it's just such an important part of European and Western world history because, let's just start from the beginning. He, during his youth, his father, which was this Paysan merchant traveling to North African ports in Algeria, Fibonacci was sent to study calculation with Arab masters in math. And so he later went on to study math in Egypt, Syria, Greece, and Sicily. And he studied different numerical systems and methods of calculation. Why is this important? Because in Europe, during the Dark Ages, they were using Roman numerals for most of their math. And it was when Leonardo Fibonacci published the book Liber Abazi. I apologize for the pronunciation if I screwed that up, but it was the Book of Numbers or something like that. And he basically introduced our numerical system, this Hindu-Arabic numerals, to Europe, which we use today. And so we would have been using Roman numerals if it wasn't for Fibonacci introducing these techniques. And so he applied it in the book to such practical problems such as profit margins, barter, money changing, conversion, weights and measures, partnerships, and the calculation of interest. But when we're doing trading, what we know it most for is the Fibonacci sequence and Fibonacci's in technical analysis. And so this is where I wanted to kind of expand on this even further. And so what was interesting is that the Fibonacci sequence, which many have learned from watching the Da Vinci Code movies, was the sequence of numbers.
One second, Patrick.
Okay, yeah.
I'm sure there's lots of people that have learned about Fibonacci from somewhere other than the
no, but that's where recently it had.
So everyone that knows about Fibonacci knows it from Tom Hanks. That's what you're trying to tell us.
That's exactly what I was trying to specifically reference. Anyway, so this Fibonacci sequence is the numbers of 1, 1, 2, 3, 5, 8, 13, 21, and so forth. And the number, if you start adding the previous two, together makes the next one. And as you're going through the sequence, actually you can see it there in the bottom right here, is that when you start dividing the one number from its previous number, you get the golden ratio of 0.618, or the reciprocal is 1.618. And what's amazing about this golden ratio, and by the way, this had nothing to do with stock markets when it was first introduced, is that how in nature this number continuously gets introduced. Everything from a seashell to our bodies. Like for instance, what I have here on that chart is our hand. As you take the measurement of the different bones, it actually measures to the Fibonacci sequence that when you curl into making a fist, you actually are doing the golden ratio spiral with your fingers. Everything from, for instance, in the human body, if you take the length of your feet to your head, that your belly button is at the 61.8 of your body.
Right.
And so everything from, and that appears everywhere in nature, from the expansion of trees and the tree rings in a tree, to seashells, to sunflower seed angles, or the diamond shapes on pineapples. Everything in nature seems to adhere to it. And what's interesting is that traders have chosen to apply this Fibonacci sequence to technical analysis. And the interesting part there, and which is one of my favorite ways to trade technical analysis, and what it is the idea of what is a natural ebb and flow of the market. So if, for instance, a stock was to rise $10, the question is then what would, if you're looking for a pullback or a retracement in a stock, what is a natural retracement? And traders that use Fibonacci's are trying to measure different levels from which a stock would naturally retrace based upon these numbers. Now, I do openly admit that there could be a self-fulfilling prophecy element to it, which is that if enough traders are all looking at the same number, the market can naturally turn there because everyone's looking at the same level. It's no different than, let's say, a 200-day moving average, right? But it is a great way for traders to find asymmetric moments to try to fade a particular move. And it's something that I often use. And I just thought it was interesting to share the history of Fibonacci and where some of this came from.
So I only have one question for you.
Oh my God. All right. I'm scared.
Only one. So the other day when Brad Pitt was up on the Golden Globes, he talked about his friend Leonardo DiCaprio, and he said LDC. And I just want to know if Leonardo Fibonacci, his friends called him LF.
They probably did, buddy. They probably did.
That's right. Okay. Good stuff. Thanks, Patrick.
All right. So anyway, it's time to move on. So Kev, the WTF clip of the week. What do we have in store here?
Oh, God. Jim Cramer, he just gives me so much to work with that he was talking about this comment from Boeing, because I guess there was some emails that had kind of been released that showed that some of the pilots had talked about Boeing being run by clowns that are overseen by monkeys. And I guess Kramer's been bullish for a while, has he? I'm not sure. But either way, once he started talking clowns, I just realized he was just walking into it. I had to do a mashup because he was doing his best Joe Pesci impersonation. So let's play the tape.
All right, let's see.
We have to have certification here around. We have to have the pilots saying, you know what, I don't really need this, but I'll take the simulation.
That's not. What's really funny is the fucking bank job away in Sea Caucus. I'm in the middle of the fucking weeds, laying down. He comes over, he says, "What are you doing?" I said, "I'm resting." "Here, you're resting?" "At a fucking beach in a park." I said, "I'm resting." "I know I'm resting. They pull me in, they start giving me all kinds of questions, this and that. He says, "Oh, so what are you gonna tell us, tough guy?" I said, "My usual, zero, nothing. I tell you, the fuck." He says, "No, you're gonna tell me something today, tough guy." I said, "All right, I'll tell you something. Go fuck your mother."
And then we don't want anyone I want to know how many hours a pilot has now flown. Or is there a co-pilot who's 300 and the pilot's 3,000?
That's true. Bing, pow, boom, bing. You saw the paper, Anthony. My head was up like this. So now I'm coming around, I start to come out of it. Who do I see in front of me? This big prick again. He says, "Oh, what do you want to tell me now, tough guy?" I said, "Bing, what are you doing here? I thought I'd tell you to go fuck your mother."
I mean, this Tehran crash sounds horrific, the way it's beginning to get pieced together. But for Boeing's sake, for the sake of the shares specifically, it's important that is separated from the 737.
It wouldn't surprise me if Boeing stock went up today.
You're the big cops.
Really funny. Really funny.
What do you mean I'm funny?
It's funny, it's a good story. It's funny. You're a funny guy.
What do you mean? You mean the way I talk? What?
It's just, you're just funny. It's funny, the way you tell the story and everything.
Funny how? I mean, what's funny about it?
People who have been buying Boeing will say they knew this, that it's 6 months away or 5 months away, and you just have to go buy the stock. I mean, the stock has tremendous support.
Yes.
Tommy, no, you got it all wrong.
Oh, Anthony. He's a big boy. He knows what he said. What'd you say?
You're right.
Funny how? What?
Just, you're funny.
And I do think that Calhoun, if he comes in, come in with a very good series of this is not the old Boeing.
You mean,
So?
let me understand this, because maybe it's me, I'm a little fucked up, maybe. But I'm funny how? I mean, funny like I'm a clown, I amuse you?
I mean, I was feel like a clown and a monkey defending everything.
I make you laugh, I'm here to fucking amuse you.
I mean, I was defending them more than they were defending
I think many
themselves.
people.
What do you mean funny? Funny how? How am I funny?
Not just. You know how you tell a story. What?
No, I don't know. You said it. How do I know? You said I'm funny. How the fuck am I funny? What the fuck is so funny about me? Tell me. Tell me what's funny.
Get the fuck out of here, Tommy.
You motherfucker. I almost had him.
You're a funny guy.
That's it, Henry. That's it, Henry.
Come on.
Hey, you want to laugh? This prick last week asked me to christen his kid. Yeah, all right, for $7,000 I charge for christening.
You really are a funny guy.
He's just, it's like, oh, that's just such a great scene, eh? Like, it's such a good movie.
Oh,
It's just like, it's just unbelievable. And it's one of the best. It really is. It's just truly one of the best movies.
Yeah.
You know what I like the best about that movie is actually when they have Layla, that's the movie they use Layla, but they use the second half of the song, the piano bit or whatever, right? Instead of the guitar part. I thought that was just a brilliant use of the song, and I just love that movie to death. And I know he recently made The Irishman, and everyone's going on about it, but it really doesn't. The Goodfellas is another league.
Right. And I do have to say, let's talk some charts here on Boeing, because this chart looks like shit. And I have to say that okay, so we had a pop in many defense contractors based on escalation in the Middle Eastern geopolitics, and like you saw big pops in Northrop Grumman and Lockheed Martin and General Dynamics, and Boeing could not catch the bid. I mean, and more importantly, it's barely filled the gap. This chart looks like it's ready to break there. Yeah, I mean, this is where you can come in and say there's no such thing as a triple bottom. Say
There's no such thing as a triple bottom.
Right, because I honestly
except in crude oil.
Except in crude oil. And so the key thing here, this chart looks like it's ready to break.
There we go.
You know what? And more importantly, if we see a break to that support line at 320, we're going to 300 to 290 on the downside, right back down to those lows from December 2018. This chart looks like shit, and Boeing is going down. That's my call.
Okay, I like it. I like the decisiveness, Patrick. Very
All right.
unusual for a technician. Usually it's if it goes lower, I'll sell it. If it goes higher, I'll buy it. Liked it.
All right.
Okay, so let's do the top 3 things to watch next week.
Top 3 things to watch next week. That's right. And
Yeah.
so the first thing I wanted to talk about is the January options expiration. And now, while everyone talks quad witching, which happens in December on the quarterlies, there's always a very large monthly January expiration because of leaps, right? They exist a lot earlier than the other monthly series, and a lot of traders that are taking much longer term stances on the markets are in these January options. And so as we get into that Friday expiry next week on the 17th, it's going to roll a lot of gamma off of the books, and there's going to be a lot of interesting things happening. And so I personally think watching that January expiration is going to be important.
Yeah, who knows? Maybe we'll have made a top already by then, but if not, and we're still headed higher, maybe the expiration will be the top, because as we've gone over before, oftentimes that Friday expiration ends up being the last strong day, and the market sells off from there.
Yeah, that's definitely something to watch. So number 2, Kev, go ahead.
U.S. CPI and retail sales. CPI always near and dear to my heart because I'm looking for that 4% tick.
Oh, Jesus.
You're going to
fail, buddy.
Yeah, it's not going to come this
you know
month.
what? I'm a seller. You know, I'm not going to put a burger bet or something on it because you're going to embarrass yourself alone just by having made the call. So I don't need to double down on it for you.
Okay, but anyways, watch for it. It's going to be important. I still think.
Hey, by the way, you lost that bet now. Now we waited for this.
That's right.
Or is this the print? right here that is going to be for the December where you get.
That's
when
correct.
You, get the
And that's the one where we're going to drink with our Market Huddle listeners. So we're going to have to figure that out. We're going to go out and do.
Like,
some
I can't
drinking.
believe you're like holding out like there's going to be this magic December print that is going to like save your ass.
You never know. You never know.
I doubt it.
You never know. But you're probably
doubt it.
right.
I'm a seller on your idea. You just don't want to admit that you're wrong.
No,
Anyways,
Patrick. Why would you give away the free option? It's dumb. From a trading point of view, it'd be dumb to say like don't give away the free option.
You're waiting for the expiry.
Exactly. You never know. It might expire. You get that one move. I kick myself. I'd be like, we drank too early. Okay, so watch for it. U.S. CPI and retail sales. It'll be important.
They're going to be important. Yeah, number one. Yeah. Well, obviously the signing of the China trade deal, right?
It's a tremendous trade deal, Patrick. Tremendous.
It is, and one of the.
It's getting translated. It's been getting translated for the past 3 weeks.
It has been, but you know what? Here's my question, Kev. What I've been sharing this idea. Maybe I'm the one that's looking like a fool for doing it, but you tell me. So let's go back, and I keep trying to relate it to what happened in the pound sterling going into the UK elections. It was a buy on rumor, sell on news. And for the last 6 months, everyone's trade deal. And what I'm curious about, whether we have like a blow-off rally into the signing of the trade deal, and that marks the top of the market. And just like the pound sterling backing off of the high pop on the election, do we see the stock market reach its kind of blow-off top, like literally within days of the signing of the trade deal? What's your over-under on that?
I don't know, Patrick. It kind of feels like a bunch of drunkards like looking outside the bar trying to find another bar that's open right now. You know what I mean? Like, it's like that's how we feel. Like, oh, maybe it'll be this. Maybe it'll be this. Like, the top will be in because of this. I don't know anymore. It's going to be over.
Come on,
it's
a pretty big pivot. I mean,
for sure. Listen, I agree. It's going to be something like that, Patrick. I 100% agree with you. It's going to be emotional. We're going to go look back and we're going to go, there it was. This was it. It's like Elon Musk with his dancing. I think that's going to be the top. You're going to look back and see Elon Musk dancing top. Right?
The Elon Musk dancing top. All right, I love it.
Yeah,
I love it.
So who knows? Like I you know what it'll be on the stock market? I'm not sure. But Trump has kind of confounded me. I keep thinking he's going to anger the market gods one of these days with all of his talking about how high the stock market is. But for some reason, he doesn't seem to have to worship the same way we do. The reality is he can do that, and it seems to work for him. And I don't know why the market gods aren't punishing him for all of his bullish talk. I don't know. I'm confused about it.
Well, you know what? I can't think of your dancing Elon Musk as a better segue into your parting words of wisdom.
Oh, yeah. So I had to use Elon because he sent a tweet that said something to the effect of, I put the art into fart. This is the CEO of this guy. He basically talking about this. Like, this is an actual tweet. Okay. So I thought I would just basically paraphrase kind of a very famous saying that a lot of people say, and it goes like this: trading is like a fart. If you have to force it, it's probably crap. That's like a grade 8 boy humor. There we go. And that's how we'll leave it. Okay. Thanks a lot for listening to us. We really appreciate it.
We really appreciate it. If you made it this far, you're truly a huddler.
That's right. Make sure you guys pick us up on iTunes, Podcast, Podbean, or whatever it is, Spotify, wherever it is, or watch us on YouTube. And you can catch me at Kevin Muir on Twitter. And Patrick, where can they find you?
At Patrick Ceresna. And you could follow me at bigpicturetrading.com, where you can get a free trial, which all of you should try.
That's right. Make sure you do
it. Shameless plug. All right.
Well, no, that's true. You should do it because all that great stuff. The Talking Charts with Patrick, it's terrific stuff, and I don't miss it. Every week I listen to it because I think it's terrific. It gives me lots of ideas for trading, and it's some of that dark magic actually works every now and then, so you got to listen to him. Okay, thanks. See you next week.
So I'm Patrick Ceresna.
Oh, wait. You know what? I'll be honest with you. Lena's sending us something. She says, don't forget to subscribe to the email. If you want to get the email notification to let us know that, when we let you know that there's a new podcast available, go subscribe at themarkethuddle.com.
There you go.
Okay.
So, we're supposed to do a close here, aren't we? Like you're supposed to say, I'm Kevin Muir. Right?
I'm Kevin Muir. And
I'm Patrick Ceresna. Have a great weekend, everyone.
You guys, take care. Okay, Lena,
that was brutal, man.
I know. You know what? I wasn't looking at my script.
Did you guys have more beers?
Yeah, no, I wasn't looking at my script. This
is like the worst beer. No.
No. So actually, let's talk about beers. Let's do it. I'm a big fan. I like it. It's
a great beer. And you know what? I love the can. I love the picture. It's pretty awesome.
This is very unusual. Patrick and I are both going to be in agreement. Lena, you are the tiebreaker. What do you think?
I actually
You start.
would give it a 7.6.
Oh my God, Lena! We lose Lena on this one.
What the heck? You're a hater.
Not a hater, no, but I don't know, something about it.
That's funny. That's interesting, actually. Okay, I give it an 8.9.
8.9.
Yeah. What about you, Patrick?
You know what? I'm gonna let you own this one. I'm gonna give it like an 8.7. I'll tell you this: it's sessionable, and I would definitely buy it. I think
I just like the pale ales. Is what I think I've decided now.
No, you know what? I would put a 6-pack of this in my fridge, and no problem. This is a good beer. If any of you can get access to the Perth County Conspiracy,
that's right.
It's a great beer, and I'm enjoying this. It's great.
Yeah, it's good. I'm a fan. I'm a buyer.
All right, so.
Anyways, what do you guys got planned for the weekend?
Oh. Well, you know, I got my buddy here who's watching me record, and we're going to go drinking.
No.
Dougie's here. Dougie's here.
That's so unusual for you.
No, I know.
You're going to do your podcast, which you were drinking, and then you're going to follow it up with
go and
drinking.
continue drinking.
Yeah.
But we're taking an
shocking.
Uber. We're being safe.
Of course you are. So it's a good thing you're taking an Uber, Patrick. Because I wouldn't want you driving because am I allowed to talk about it?
What's that?
You have to talk about it.
Am I allowed to talk about it?
Talk about what?
When you took me for a ride in your new car.
No, I'm not. No, you don't talk about this. No, you're not allowed to talk about that.
Now you have to talk about it.
No, you know what you have to do when you get to meet Patrick in person? You can ask him about it. Oh, there we go.
I'll tell you the story. It was shameful. It was shameful.
So Patrick picks me up and we go in his brand new car.
Well, no, yeah.
I want to set the
He
scene.
doesn't
Very
drive
new.
a Hummer anymore.
Yeah.
No.
That's right.
My daughter does. Thank you very much. I said.
Oh, you don't want to listen. You don't want to get rid of that.
My 19-year-old daughter to fucking
right.
university driving an H2 Hummer.
That's right. You don't want to get rid of that American Beauty like that H2 Hummer. That thing's going to be a classic. You want to make sure you keep it.
Oh, I'm
pretty sure that it gets egged by like environmentalists everywhere you go
on campus.
Yeah,
she survives. She survives. No one.
Okay, so anyway, so Patrick's got a new car, and he's like driving me to the subway.
Well, we were doing the show, and I decided to drive you back. I was like, and I ran out of gas. Like a fucking idiot.
He
like
ran
I
out
ran
of
out of gas. It was the worst.
Where did you run out of gas?
On the QE, not on the Lakeshore.
On Lakeshore. I fucking turned like a fucking idiot. I run out of gas. Like the fucking new car doesn't beep to tell you they're fucking low on gas. Like bullshit. Like.
But it's in front of you.
I know. Don't. I had a beer or two, and I wasn't paying attention. It was so embarrassing.
Well, yeah,
it was so embarrassing.
Of course, you were under the legal limit. We would never imply that you were actually.
Oh no, because I mean, I was drinking beer over a 3-hour time frame. I had 1 or 2 beers. Like no, I was fine. It's not like I was hammered, but.
So then, what happened after?
Well,
I took an Uber and left him.
He took an Uber and left me. I had to wait. I had to wait for CAA, which is AAA for most Americans. But like, fucking tank me up. It was so.
Do you know what, Patrick? My buddy used to say this very sexist remark, and I'm going to repeat it, but I would never, say this.
Oh, you would never. You would never.
No, but this is what he used to say. He used to say, I'm gonna have a course for my wife. It's going to be called Gas and Oil. Your car needs both. Okay? So I'm going to have a class for you, Patrick, that's even worse. That's even more basic. Gas. Your car needs it.
What?
Yeah.
What? A A car needs gas? Dude, I know that. I drove a Hummer. That fucking thing got like 100 liters on 400.
That's right.
I got
All you
400
did was-
kilometers, which is like fucking 250 miles.
That's
on
right. You just
fucking
drove
100
from gas station to gas station, right?
Basically, for our American friends, that's what is that? Like a 25-gallon tank, whatever, like a 100-liter tank, and I was getting like 250 miles or 400 kilometers, whatever the fucking number conversion is. It's a fucking beast. Now it's my
terrible.
daughter's problem. It's my daughter's problem now.
Sorry, I'm Patrick. I'm sorry I outed you about your gas situation.
No, it's all right. You know what? It's like,
It's all amongst family. It's by this time, you only have the ones that truly love the Huddle listening to you, so they're going to be on your side.
Most
no
people,
problem.
most people shut us off already.
Yeah, that's right. Okay. How about you, Lena? What do you got planned for this weekend?
I'm seeing my baby niece tomorrow.
Oh, that's fun. How old is she?
She is now just over 10 weeks, I think.
Oh, brand new.
Yeah.
Brand new.
Sorry. No, that's 3 months. Sorry, October she was born.
Okay, so
Yeah.
listen, I have a little bit of advice for your, what is it, your niece? So that's your...
My
is it-
sister-in-law.
Oh, your sister-in-law. They're at the worst part right now. I always talk about the 100 days of hell. The first 100 days are terrible, and then it gets better. So tell
But you
them
know
about
what?
the 100 days of hell. They're almost through it.
I asked them, and they're doing fine. She's
Yeah,
like,
they're
oh,
lying.
she sleeps through the night. Like, there's no reason for them to lie to me. Like, I always offer them, like, oh, do you want some help? They're like, no, we're good. I was like,
I don't
"All
know.
right."
Well, they must have gone to church and prayed a lot or something, because I never had any of those.
So what I'm going to do here is I'm going to actually pass my headset over to my buddy Dougie here, who was who's the co-organizer of the 12 Pubs of Christmas, who miserably failed at Bar 11.
Oh God, we gotta get him on.
I'm going to get him on here. Hold on. Here
Put
we
him
go.
on. Doug, are you there?
Yeah, the last comment was a falsification. I'm a lawyer. I'm putting him on notice now.
You're hereby serving them. Okay, so did you fail at Bar 11 or not? Give us the facts.
I have no recollection of that event.
Okay, let's just talk in the hypotheticals now. If you were to fail at Bar 11, did you fail because you just couldn't drink anymore, or did you have like an output problem, let's say?
No, I suspect I just listened to wiser voices who thought that it was perhaps time to head southerly direction down Lawson's Road.
Instead of Patrick telling you have to keep going.
Did you? Your wife was there and she cut you off?
Oh no, she was 3,000 miles away, fortunately.
Oh, well, that's smart. That's the only time you should actually be doing that. So who was it that was not? Because it wasn't Patrick that was telling you to stop. Like, so there's no way, because I know Patrick.
No.
Patrick would be telling you.
Probably saying you
Have you not
to
heard of his the message behind his acronym Triple P?
Peer pressure, Patrick.
Peer pressure, Pat. How's peer pressure, Pratt, going to do anything other than tell me have another one, Doug?
Yeah, of course. He's actually got a problem that way. He just keeps going.
Yeah, he forgets to put gas in his car.
Yeah. But he just keeps going. So you tapped out at 11. Have you ever done the whole 12?
Oh yes. Last year. I've missed 2 out of 3 though, I have to admit.
Well, you're a trooper for even trying, because it just sounds stupid as hell to me.
Oh, come on. Where's your community spirit?
The community spirit. It just sounds just insanely dumb. So, like, I don't like feeling like the earth, that feeling when you were in college when you drank too much and the whole room started spinning. And that's all I can think of. At 12, that's going to happen to me.
That's fair enough. But,
yeah.
Sometimes
so that's
to be stoic.
Yeah, stoic. That's what Seneca said. Sometimes you have to finish the 12 pubs of Christmas. And Marcus Aurelius or whatever it is.
Well, the concept is borrowed from a good friend in London, England, and I can tell you the British put it on in a very, very elegant fashion.
Okay.
So,
well, there we go. So we have to take the British stiff upper lip and we have to finish it like they do in 12 pubs of Christmas. Anyways, Doug, it was a pleasure meeting you. I'll look forward to maybe next year completing it with you.
Absolutely. Have a good evening.
You too. Take care. Okay, Lena, have a great weekend.
You too.
Okay, bye-bye.
All right. Take care, guys.
Okay, bye.